welcome back to my channel. Today we are tackling a crucial topic for any business looking to make some sound investment decisions: capital budgeting techniques. In this video, we will be exploring the key capital budgeting techniques that business use to access the variable and profitable of their investments. We will covering the method like net present value, internal rate of returns, payback period, and many more. Whether you are a business owner, financial manager, or a student of finance, this video will be equipped to you with the tool to make better investment decisions. Don't forget to like. Let's get started with understanding capital budgeting techniques. Starting with the introduction, capital budgeting technique. Capital budgeting is a process of evaluating long-term investment opportunity to determine the financial feasible and potential return of investment. Capital budgeting play a crucial role in a strategic decision. Introduction. Let's start with the introduction of capital budgeting. Capital budgeting is a process of evaluating long-term investment opportunity to determine the financial feasible and potential return to the investment. Capital budgeting play a crucial role in strategic decision making by helping organizations allocate resources efficiently, prioritize investment opportunity, and align investment with a long objective. It enables business to make information decision about which project or asset to pursue, ensure that investment contribution to the company's growth, profitability, and competitiveness in the marketplace. By evaluating the financial visibility, risk, and potential return of a various investment option, capital budget facilitates strategies, planning, and resource allocation to maximize shareholder values and achieve organizational goals. Let's see the objective of capital budgeting. The primary objective of capital budgeting is to maximize shareholder wealth by making strategic investment decisions and generate positive returns and contribute to the long-term growth and profitability of the organization. Capital budgeting involve assessing potential long-term investment opportunity to determine their financial feasibility, profitability, and alignment with the organizational goal. By evaluating this opportunity, business can make informed decision to allocate resource efficiently and make shareholders value over time. The main objective of capital budgeting is to maximize shareholder wealth by selecting investment opportunity that yield the higher returns relative to their risk. This involves analyzing potential long-term investment to ensure they contribute to increase the company's value over time, unlimitedly benefited shareholders. Capital budgeting ensures financial sustainability by carefully evaluating long-term investment opportunity to allocate resources efficiently, managing risk, maintaining liquidity, unlimited contribution to the organization's long-term sustainability. Type of capital budgeting. There are four types of capital budgeting: net present value, internal present rate, internet. Types of capital budgeting. There are four types of capital budgeting: net present value, internal rate of return, payback period, profitability index. Let's see what is net present value. Net present value compared to the present value of expected cash flow with the present value of cash flow to determine if an investment generate positive returns. Internal rate of returns calculate the discounted rate at which the present value of cash inflows equal to the present value of cash flow indicates the project profitability. Payback period measure the time required for an investment to recover its initial cost through the expected flow. Profitability index compared to the present value the expected future cash flow to the initial investment, providing to the ratio to access the project profitability. Let's see some detailed information about payback period. You can see the formula of payback period. Payback period is equal to initial investment upon annual cash flow, which include in payback period is equal to year before full recovery plus remaining investment upon cash inflow in final year. The payback period in the time it takes for an investment to recoup its initial cost through generating cash flow. It measures the investment liquidity and risk with shorter payback period, indicating quicker returns. Advantages. There are advantages of payback period, which include capital budgeting method like NPV and IRR help in selecting profitability projects, ensuring efficient resources allocations and maximizing shareholder wealth. They also aid in risk assessment, enhancing decision making accuracy. If there are advantages, there are some limitations also. This method also may not consider factors like uncertainty, changing market conditions, and non-monetary benefits, potentially leading to the inaccuracy investment decisions. Additionally, they rely heavily on the future cash flow prediction, which can be subjective and prone to error. Now we can see net profit value. Let's first Net profit value measures the present value of future cash flow generated by the investment, discounted at a specific rate. A positive NVP indicates the investment in profitable, while a negative NPV suggests it may result in a loss. It's a key tool to capital budgeting for evaluating investment opportunity. Important decision making. NVP is a crucial in decision making as it helps assess the profitability and the feasibility of investment opportunity by conducting the time value of money. It enables business to compare the present value of expected cash flow in the initial investment cost. The positive NVP indicate that the investment is expected to generate return greater than the cost of capital, making it valuable tool for making improved investment decision making and maximizing the wealth. On the left hand side, you can see the formula to calculate NPV, which include cash flow at time t. R denotes as discounted rate, T denoted as time value, and C0 initial investment. To calculate NVP, determine the cash flow for the each period, discount each cash flow back to its present value using the discounted rate. Sum all the discounted cash flow, subtract the initial investment from the sum of discounted cash flow to get the NVP. Internal rate of returns. The internal rate of return, that is IRR, is a metric used to evaluate the potential profitability of an investment. It represented the discount rate at which the present value of a cash flow equals the present value of a cash outflows. In simpler terms, it can be stated as it's the rate of return that an investment is expected to generate over a lifespan, and if they excited the cost of capital, the investment is considered worthwhile. Interpreting the IRR result, if the IRR is greater than the required rate of returns of cost of capital, the investment is considered to attractive because it generates return higher than the expected rate. If the IRR is if the IRR is equal to the cost of the capital, the investment break even, meaning it generate return exactly equal to the cost of financing. If IRR is less than the cost of capital, the investment may not disable as it failed to meet the expected rate of return, potentially indicates the loss and unprofitable venture. Left hand side, you can refer the formula to calculate IRR. Iterate with the different value of IRR until the equation equals zeros, usually done using trial and error, interpolation, and specialized software. Next would be the profitability index. The profitability index, also known as the profit investment ratio (PIR) or benefit cost ratio (BCR), is the financial matrix used to assess the profitability of an investment by comparing the present value of its expected future cash flow to the initial investment cost. It is calculated by dividing the present value of cash flow by the initial investment. A PI generated greater than 1 indicates that the investment is expected to generate positive returns, while the PI less than 1 suggests the potential loss. The significance in investment analyze. The potential index PI is significant in investment analyze as it provide significance in investment analysis. The profitability index is significant in investment analyze as it provide an significance in investment analysis. The profitability index is significant in investment analysis as it provides the quantitative measure of attractive of an investment opportunity. A PI generate then 1 indicate that the present value of expected cash flow exceeds the initial investment, suggesting a initial investment suggests a potential profitable venture. It helps when investors prioritize the project by comparing their relevant profitability, enabling information decision making and efficient allocation of resources to maximize returns. Let's compare the four capital budgeting techniques, that is net present value, IRR, payback period, and profitable index, that is PI. NPV considers the time value of a money and provide a dollar value of project profitability, whereas IRR measures the project's rate of return and is useful for comparing investment against the company's required rate of return. Whereas payback period offer a quick assessment of a liquidity by ignoring cash flow beyond the payback period. Whereas profitability PI measures the value generated by the dollar invested, comparing the NPV by considering the investment size. You can refer the case study for NPV. In this case study, ABC Manufacturing is considering considering expanding its production capacity by purchasing new machineries. The initial investment of a machinery is $5 lakh. The project is expected to generate additional cash flow of $1,50,000 per month for the next 5 years. The company cost of capital is 10%. You can refer this method for the solutions. Next, we would see the risk management. Risk indicates identifying potential risk association with the investment projects such as market risk, technological risk, regulatory risk, and operational risk. Evaluating the likelihood and impact of each identifying risk on the project cash flow, profitability, and over financial performance. The implement strategy to mitigate or manage identified risks. This may include diversifying investments, conducting through market research, securing insurance coverage, implementing quality control measures, and or establishing contingency plan. Performance sensitivity analyze how change in the key variables such as sales volume, pricing, and product cost impact the project financial outcome. This helps in understanding the project sensibility to the various risk factors. Use of risk adjust discount rate. Adjust the discount rate used in the capital budgeting analyzed to reflect the level of risk associated with the investment project. Higher risk project may require the higher discount rate to account the increased uncertainty and the potential loss of value. What are the challenges faced? It includes uncertainty, complexity, subjectivity, trade-offs, dynamic environment, and resources constructed. Future cash flow, cost, and market conditions are uncertain, make it challenge to accurately assess the qualified risk. Investment projects often involve multiple sources of risk, include market risk, operational risk, and financial risk, which add complexity to the risk management process. Risk access involves subject judgment and accomplish, leading to the potential bias and inaccuracies in risk identifying and analyze. Risk management strategy may involve trade-off between risk and returns, balancing the risk mitigation measures with the need to achieve derived investment return can be challenging. External factors such as changing in economic condition, regulatory requirement, and technological advancement can impact the risk profile of investment project, requiring ongoing monitoring and adaptation of risk management strategy. Lastly, I'd like to conclude that effective risk management is essential in capital budgeting to mitigate the potential negative impact on an investment project and enhance all over the financial process. Despite the challenges posed by the uncertainty and complexity and subjectivity of organization can be navigate this hurdle by adopting systematic risk management practices include risk identifying, access mitigation, and ongoing monitoring. By integrating risk management into the capital budgeting process, organization can make more informed investment decisions, improve project outcome, and unlimitedly maximize the shareholders' value. Thank you.